All right, let's jump right into this. Welcome to a brand new explainer video on the Gap Advisors IS Clinic YouTube channel. Today, we've got a really fascinating case study that perfectly illustrates how just a few carelessly chosen words in your financial statements can trigger a complete cascade of compliance failures. Seriously, it's a domino effect. We're going to do a forensic breakdown, dissecting a real-world voluntary retirement scheme disclosure and mapping it directly against strict IS compliance rules. If you're an auditor, a finance professional, or maybe a CA student, you're definitely going to want to pay close attention to how easily material information can be obscured. But hey, before we put this real-world evidence under the microscope, we need to set the stage. It's absolutely crucial we establish some ground rules so we're all on the exact same page. Now, please note that the views expressed in this explainer are entirely the personal views of the author. They are not binding on you, the audience, and they're really just here for educational purposes. Also, just keep our baseline parameters in mind as we go through this. Our functional and presentation currency is the Indian rupee, so any currency other than INR is treated as a foreign currency. Our reporting period runs from the 1st of April to the 31st of March. And most importantly, always seek expert help before taking any action, or, refraining from taking action based on the personal views we discussed today. Every single audit is unique, and professional judgment is key. Okay, here's our quick roadmap for today's explainer. First, Exhibit A, the vague policy. Second, IAS 19 requirements. Third, obscuring material information. And fourth, the Gap Advisors solution. Let's move right into Section 1. Exhibit A, the vague policy. So let's start our investigation by looking directly at the evidence. We aren't dealing with hypotheticals today, folks. This observation comes straight from the published IS financial statements of an actual listed company, which GAP advisors downloaded and independently reviewed on a suo moto basis. Take a look at this text regarding their voluntary retirement scheme, or VRS. It reads, "Expenditure on voluntary retirement scheme, VRS, is charged to the statement of profit and loss when incurred." Now, at first glance, that might sound like totally standard accounting jargon, right? But let's stop and ask the critical question here. When exactly does the company consider this VRS expenditure to be incurred? The policy explicitly says it's charged when incurred, and that instantly leaves any auditor or any primary user of these statements with a massive, glaring doubt. Think about it. Does incurred mean when the employee accepts the offer? Is it when the cash actually leaves the bank? Or maybe when management first approves the scheme? This ambiguity right here, that is exactly where the problem starts. Which brings us to Section 2, IAS 19 requirements. To fully understand why the phrase "when incurred" is such a huge compliance trap, we have to face the strict reality of the accounting standards. This comparison perfectly illustrates the disconnect. On one side, we have the company's little shortcut, charged when incurred. But on the other side, we have the actual rulebook, paragraph 165 of IAS 19, dealing with employee benefits. And let me tell you, this standard is incredibly specific about termination benefits. It mandates that an entity must recognize a liability and an expense at the earlier of two highly specific dates. Number one, when the entity can no longer withdraw the offer of those benefits. And number two, when the entity recognizes costs for a restructuring under IAS 37. So by just writing "when incurred," the company's policy totally ignores the precise timing demanded by paragraph 165. It makes their shortcut completely, fundamentally non-compliant. Let's look at the fallout in Section 3, obscuring material information. You see, this compliance failure doesn't just stop at IAS 19. It actually bleeds right into how the information is presented. According to IAS 1, paragraph 10a, the statement of profit and loss has to comprise two distinct sections, profit or loss and other comprehensive income, or OCI. The standard explicitly states these sections have to be presented together. Yet, if we look back at the company's policy, it literally just says VRS is charged to the statement of profit and loss. It completely fails to disclose which specific section the expenditure is charged to. That lack of granularity, that's a direct presentation failure right there. Returning to the exact phrasing they used, we can see how this vague wording acts as a major compliance trap. What might seem like a minor typo or drafting oversight to some actually triggers another very specific, very serious rule in the realm of IAS. Let's see how this builds into a much larger issue. Paragraph 7 of IAS 1 explains the whole concept of obscuring information. It clearly states that information is obscured if it's communicated in a way that would have a similar effect on users as omitting or misstating that information entirely. And it even gives examples. Example A is literally when information about a material item is disclosed, but the language used is vague or unclear. So, by relying on that ambiguous phrase "when incurred" and completely failing to specify the section of the P&L, this company has effectively obscured material information from the primary users. They didn't just write a sloppy sentence, they flat out violated paragraph 7 of IND AS1. Now, how do we fix this? Section 4, the Gap Advisor Solution. Discovering these obscure errors before they get published and signed off is absolutely vital, and that is exactly where Gap Advisors steps in. We're super passionate about empowering you with this kind of inside knowledge. In fact, this specific observation was featured in the 219th edition of the Gap Advisors Task Weekly newsletter. This is an incredible resource authored by C.A. Manish C. Iyer, director at Gap Advisors. To date, there are over 230 editions of this weekly newsletter published. If you're on LinkedIn, which I'm sure most of you are, I highly recommend you go and subscribe to it for free right now. It's just a fantastic, consistent source of top-tier IND-AS analysis. Furthermore, you can completely supercharge your audit preparation by registering for free at gapadvisors.com. The site hosts an absolutely unparalleled issue repository containing over 4,500 issues and their detailed responses on Indian accounting standards and Indian GAAP. Literally, anyone can register for free and submit issues on IND-IS and Indian GAAP and get a detailed response delivered directly to their email inbox. This is a massively powerful tool, particularly for auditors who need to flawlessly document exactly how they addressed any issue relating to the application of IND-IS. So please, don't let your clients or your audit firm fall into the trap of obscuring information. You can get your financial statements independently reviewed by Gap Advisors before signing them. The process is remarkably simple. Step 1, just export your financial statements into a near-to-publishing PDF format. Step 2, email that file directly to info@gapadvisors.com. And Step 3, receive a comprehensive independent review to ensure your disclosures are totally airtight and fully compliant with the standards. Now, if you want to explore the really granular details of this specific VRS observation even further, we've got you covered. Connect to the Gap Advisors IND-AS Clinic podcast, which you can find on Spotify, Amazon, or right here on YouTube for a comprehensive audio deep dive into all the nuances of this exact case. Thank you so much for your time and focus today. If you found this explainer valuable, please take a quick second to like the video and add a comment below. And if you aren't already, definitely hit that subscribe button for the Gap Advisors IND-AS Clinic channel. We'd also love it if you could share this video among your contacts, your colleagues, your audit and finance teams, and especially among students currently pursuing their CA course. Your shares really help us spread vital, practical knowledge of Indian accounting standards across the whole profession. Before you go, I want to leave you with this final, somewhat provocative thought to take back to your desk. Take a hard look at the disclosures you're working on right now. Is vague language in your financial statements secretly obscuring material information right under your nose? Review your own drafting closely today because, as we've just seen, the tiny difference between writing "when incurred" and referencing true compliance dates could literally be the biggest risk hiding in your next audit. Stay sharp, stay compliant, and we will see you in the next explainer.